Start with the basics. What is a sector? Understanding how you could potentially use a rotation amongst sectors to either manage risk or to add extra diversification into your portfolio. We'll also be addressing some of the ways that you can use sector rotation, whether you're going to use that in a relatively aggressive way or perhaps in a risk mitigation way to limit volatility. We also see that there are some different things we need to understand, including the business cycle and your own current allocation in order for you to apply this in your own investments. So we'll take a look at this, including how to find investments over the course of the presentation today. Knowing that that's the case, knowing this is where we're ready to go ahead and dive in and understand, I've got a few ideas that I want to present to you before we go ahead and pass over to you, Peter. So the first is simply the definition. What is a sector? As we take a look, what is a sector? We're trying to just understand that when we talk about the stock market, it is made up of a whole bunch of individual stocks. And even though each one of those stocks is different and will perform differently, birds of a feather flock together. They tend to act similar, ones that are similar. And so we're going to take a look at how that occurs. In this case, the one we're highlighting on the slides is the information technology sector, one part of the overall investment in the world. You could focus all of your investing in the companies that make up information technology, ones that you recognize like Apple, Microsoft, NVIDIA, Cisco, and Salesforce. Or you could invest in that sector as a whole, or we could even zoom out further and understand that this, though it's a large part, it is still only 30% of the total market weight. And there are instead a total of 11 different sectors if you are one who uses the Global Industry Classification Standard, which is what Fidelity shares with you on our website. Those different sectors include, yes, information technology, but also energy, materials, industrials, consumer discretionary and staples, healthcare, financials, communication services, utility, and real estate. Each of these different parts of the market represent some difference to others, but hopefully some similarities to others. We've heard day in and day out about interest rates and how interest rates may change in the near future. They've gone up quite a bit over the course of the last year and a half. But expectations now are that they might start going down. In fact, we heard from Jerome Powell just this morning on some of that possibilities and what the Federal Reserve would need to see in order to start bringing those rates back down. Companies in the financial industry will be remarkably affected by any change that the Federal Reserve makes to the current and future interest rates. As a result, this lumping together of the financial companies, these are your banks, your insurance companies, even some other versions of financial that you hadn't quite considered in that same vein. Nonetheless, as we think through financials, all of them will have some similarities in regards to the reaction to what happens from the Federal Reserve. And on a more broad-based focus, we might think about consumer discretionary and consumer staples. Consumer discretionary is going to be those luxury goods that we love to have, like to build into our budget, but we aren't rushing to the jewelry store to buy extra bling when the economy is doing very, very poorly. In fact, consumer staples, things like grocery stores, will tend to do better when the economy is doing poorly than will consumer discretionary. Those luxury items, you might include in here your restaurants, your travel, some of those other items are all going to be here under consumer discretionary. Those are the first things we tend to cut when we see things either on our own personal financial outlook change or in the broad scale when the economy starts doing better or worse. We saw an absolute extreme of this show up in 2020 when COVID lockdowns forced many of the consumer discretionary parts of the market to close and to close immediately. Do you know what did really well during that time frame? Companies like Costco and other grocery stores that suddenly saw all of our food needs being purchased through the grocery store as opposed to eating out. There is simply a difference in how the parts of the market will perform. So, with that as kind of setting the background here, Peter, let me pass the microphone to you to introduce a little further the general idea of these industries and sectors. When you find it appropriate, I also have that screenshot we talked about before.
Yeah, absolutely. And I'm happy to be here. I think it goes back to kind of what we're looking at here and now, and that terminology for classification certainly stands out to me in this endless universe of different types of investments that we all can make, and with at least speaking about my account, limited resources to put towards them. You do want to know what it is that you're investing in. You also want to be mindful of those characteristics that might come along with any investment that you have. So I think it stands to reason many of you are already familiar, at least within reason, I would venture to say. If I was to, like you had mentioned, Jacob, talk about different companies, well, if I was to say, Bank of America, JP Morgan, whoever it might be, you'd probably venture to say, okay, that's a bank. They probably fit within financials. We could do that same drill for a number of other different companies and then think about what sectors they might fall into, as well as these industry groups, industries, sub-industries, you name it. But I want everyone at least just to take away from this visual, kind of just that stacking nature that you're seeing. It's really more or less about being able to understand the representation that, okay, there is a company, there might be a few that are like it. What maybe group do they fall into? Restaurants, leisure, like you had mentioned with Costco, maybe some staples in contrast to some of those other discretionaries that we are going to be getting into and discussing. So do keep that in mind because I think that that actually goes into a questions that we had seen so far. A question had come up, and maybe you're answering it now on the fly, but maybe considering international or global stocks as a sector. When I think about sectors, it kind of goes back to that previous slide that we were looking at. But I like where your mind's at, Jane. Thinking about global stocks, maybe international stocks. Think about how, as a grouping, they might have different benefits or drawbacks, kind of risk reward throughout different business cycles. But then you're almost even taking it another step further. You're having to not just think about, okay, what's the business cycle maybe in the States, US here, but if it's a global or national, what is the global market looking like? Well, what are maybe certain regions or countries doing well or perhaps not performing so well? So I like where your mind's at and thinking about a sector maybe versus international or global, but it does go back to that broad theme that I was speaking towards, which really gets back to how can we maybe group or classify really any investment that we are making. Here we talk about sector weighting a bit, and a few things that we wanted to go ahead and highlight. I think that is visualized here with these slides that we have. These sector weightings can change over time. I could almost input here, they do change over time. And the reason that that could be important, or that it should be important for many of you, also goes back to what it is that you're invested in. Maybe you have exposure towards a type of exchange traded product, an ETF, maybe a mutual fund. Maybe you are tracking some type of index or some type of benchmark. You do want to be mindful that, as we can see here in our illustration, information technology still was a solid, well, 2/10, maybe almost a 1/4% there of the whole as far as the weighting in the S&P 500 back in 2019. Here we find ourselves now in 2024. That weighting has only increased. Info technology now making up just shy or perhaps even eclipsing 30% at this point in time. And that fact of the matter just goes back towards not just the kind of top sectors themselves, but also some of these that potentially were maybe a bit smaller, was not always the case. So just do recognize that there are going to be ebbs and flows in the sector exposure that you have, even comprised in different indexes or benchmarks that are out there. And then we talked about, well, higher concentration in just a few of those sectors. Some of this begins to, at least as far as these concepts, dovetail into why maybe having some type of sector rotation strategy or concepts that we're going to talk more about. We see it here. Market weight is the said, 29.81%. You reserve the right to either be what's referred to as market weight, meaning, you know what, I'm just going to go with the flow. I'm going to kind of do what the market weighting is out there. Or, as we're going to come to find out, maybe you want to potentially put a little bit more exposure and be overweight. Maybe you would actually like to do the opposite. Maybe you think, you know what, it's had a very good run, but I'm feeling as though the tides might be changing. Doesn't necessarily mean that you need to completely get out of the entire position or entire sector, but maybe trimming a position, maybe then going from overweight back down to market weight, or maybe from overweight actually putting an underweight in there. Folks, when we talk about that weighting, we're going to come to find it's not necessarily going from a 29, call it 30% down to a 5%. Now, you certainly could, but when you're seeing this from Argus or CFRA, oftentimes they're talking about a very, very fine-tuned or small amount, maybe from the 30%, maybe down to 28, 28 and a half, maybe if they're overweight, up to 30, 31, something of that nature, but not a tremendous amount. The ability to go ahead and actually have those ebbs and flows in your portfolio going to be completely up to you. And why is that so important when you think about those weightings? Well, as we're seeing here on this title slide, it can be a key performance driver. And that's also another reason why, rather than potentially looking for individual stocks themselves, maybe rather than actually looking for hours on hours and hours, the one company that's going to go ahead and drive that performance in your portfolio, potentially you think, you know what, I think that there are maybe headwinds in a certain sector. I'm kind of invested in some of these companies, or maybe have exposure. Maybe I need to tone that down, and perhaps I need to look for companies that are in a sector that I feel like has maybe some tailwinds to it. And what this is designed to do is actually show us, if you are looking at least from the sample size, rolling 12-month analysis, want to give these disclaimers, a pretty large sample, you'd have to argue, roughly 22 years there of analysis from these variants on a large sample of stocks. The whole point is that this sector selection can account for a large fraction of those individual stock performances. And we all know what that's like. I can raise my hand and say, maybe I was invested in a particular sector, maybe a company within a sector, and it just wasn't performing quite as well. This is to show us, or at least just encourage, there's a number of factors that are going to go ahead and drive returns. And a portion of this, of course, for any individual company itself, going to be coming from those sectors that we are invested in. And that's what I wanted to go ahead and at least just begin to introduce. When we are thinking about the introduction to the sector rotation strategy, it goes a little bit back to what I had said, but let's get a little bit more granular in nature here. When we're thinking about why we might want to do this, so far, we've said a whole lot about what are sectors, what might be overweight, what might be underweight. Now we're starting to get into a little bit more about the why. And I think that some of these bullet points are going to go ahead and speak towards that. And we can certainly go ahead and read through these. But on the face of it, if you're thinking about different sectors like we were speaking about, and like Jake had mentioned about the Costco example or some of those others, historically, what you are going to find are different sectors, going back to those characteristics, are going to maybe either benefit from certain environments in the business cycle, and other sectors maybe are going to suffer, or if they're not suffering, perhaps they're not maybe benefiting to the degree that other sectors might. And that is what comes to the thought process of being able to rotate into and out of different sectors in the economy throughout those different phases. I think lots of that goes back to also the thought process that from the security for companies, many of these same industries are going to tend to move with similar patterns. I think a pretty classic example of this that you really can't miss these days is you could almost go ahead and mutter the words artificial intelligence on a conference call, or if you were aligned with some type of chip, cloud computing, software, maybe even the hardware that goes into it, it's going to be pretty tough to go ahead and escape at least a little bit of that hype. The thought process being, well, if this is going to be a major boon for maybe this industry, this sector, I just want to get my hands on some of these companies here because the thought process historically is that what's the phrase? The tide's rising, all boats are going to go ahead and get lifted with that rising tide. Do keep in mind, though, that is a double-edged sword, and that's when we talk about those sectors that might not be benefiting from this. All of those companies, while they are very closely aligned, if the maybe drawback to the sector or industry is there, that might be impacting all of these individual companies as well. So being able to have some type of thought process, have a trade thesis as to one, kind of where we find ourselves in maybe a more macro environment, two, looking at where the business cycle might be, or kind of the phase, as it's called, of the business cycle and where we find ourselves, should allow you to then project, how do I want, for lack of a better term, how do you want your team structured? If you think about it from a sports, standpoint, I know the basketball finals just ended. Being here in Dallas, Fort Worth, was upset to see our team lost, although you have to argue we were not the better team on the floor. But enough with the anecdotes. The point being, if you are trying to construct your portfolio, by all means, you certainly want a lot of players that can, swing for the fences. You want different players that are able to go ahead and give you gains, but sometimes you also need to be able to position yourself to play a little bit of defense. And often when we are thinking about being able to add some alpha, manage risk, even help protect against inflation, there are going to be, with your portfolio, opportunities to be able to try to get some of that capital appreciation towards the upside, but not just necessarily what are my returns. There are many, many professionals out there and even some retail investors that think about it from that standpoint of what are my risk adjusted returns rather than just saying, oh, hey, I was up 10% this year. How much risk were you having to pony up for that return that you were receiving? And that is lots of times when you are structuring your portfolio, being able to glean on different sectors throughout these business cycles or phases can make a world of difference to say, you know what, I'm feeling as though we're humming along. We might be set up for whatever it is that you see in the future, which is why maybe I want to go ahead and kind of align my portfolio in order to go ahead and maybe reduce the volatility, reduce the potential for a drawdown while still looking to try to take part in maybe some of that upwards momentum that we might be observing. Let me pause there at least for just a moment. Once again, just kind of on the introduction, there is so much more to this, Jacob, but what would you add maybe to any of what I've talked about so far, or perhaps piggybacking kind of off the thought process just in general from that sector rotation thought process?
Let's see if we can dive a little deeper into these ideas, this opportunistic, defensive, or preemptive, maybe by thinking a little bit about what we are seeing currently in the market. So let me go ahead and pull up my screen and we'll see what's been happening. You glimpsed this at the very start of the session if you're watching real closely. But this is a screenshot from our partners at Bloomberg, a third-party data resource. In this case, subdividing those sectors even further into the industries. So we've got the market as a whole, then we have 11 different sectors, and then we've got a whole bunch of different industries that make up the sectors. For example, inside of information technology, we've got companies like Apple that make equipment, that make iPhones and Macs. And we also have other companies like AMD and NVIDIA and Micron who make chips, the processors that go inside of those computers. And so we can subdivide just a little bit based upon how that works. And those are the industries inside of them. And we find that semiconductors, as well as semiconductor equipment, have been the top performing year to date. So from the start of this year till present, we're seeing that though the S&P 500 is near all-time highs, almost 16% positive, 75% would have been your return if you were investing instead in semiconductors. 39% if in semiconductor equipment. And as we continue down the list, all of these top 10 were substantially above the index as a whole. Whereas down here at the bottom, we had one sector or one industry inside of a sector, the drug retail index, off by 55%. Folks, this is how big of a difference it can make to be in the right versus the wrong parts of the market. Yes, the market as a whole was 16% positive so far this year, but I hope you can see that vast difference. This is all inside of the S&P 500. Have you ever heard people say it's a big company, it's too big to fail, there's no way that it's going to go anywhere? Well, tell that to the people who invested in drug and retail who now have half of the money that they did at the start of the year. Maybe worse, depending on the individual company that they happen to have purchased. As we take a look through, this is why you may benefit from adjusting your portfolio based upon the different moments and opportunities you see out there in the market. So let's go ahead and take a look and see how that relates over time. Ways that you can do so. One way is for us to adjust our strategy in order to change the volatility that we're looking at. So for example, if we were to take a look at our market as a whole and recognize that some parts of the market have greater size of swings, bigger ups and bigger downs, and we're concerned about that size of ups and downs, that's what we call volatility in financial analysis, then we have to think that there's a possibility that we will benefit from adjusting our portfolio towards those that have been historically less volatile. As we come down here to the second step, another more active strategy is instead to seek to invest in those parts of the market that are either currently outperforming or expected to outperform given your forecast of the current or future phase of the business cycle. And for those of you who are wondering what in the world is the business cycle, don't worry, we'll take a look at that in a few slides. But as we take a look, here's how that could work out. As we take a look and see how a managed risk portfolio might perform, where instead of simply investing in the market as a whole, that's the red benchmark, the green risk managed sector portfolio is simply being aware of the risks in them and adjusting the portfolio on that basis. This is a long-term study. This ended way back in 2012, but it gives us an idea of how this can change. And we see that our annualized volatility for the benchmark was about 16%. That means that in order for us to understand what an average return is, maybe you've heard the S&P 500 has an average return of 8 or 10 or 12%, depending what time frame you're looking at. The volatility tells us how closely grouped all of the different returns were that produced that average. 0 and 16 and 32 averaged together give us 16, but that's a lot different than 15, 16, 17. Volatility is how widely dispersed those returns are over the course of time. And we see that our risk managed portfolio was able to limit that difference between them. And also over here to the right, the drawdown is saying, what's the worst loss from that peak until the current value? What's the worst loss that the portfolio experienced? The benchmark lost upwards of 20%, whereas the risk managed portfolio was able to keep it to 15%. All of this to say that if we manage our portfolio intentionally, we can make a dramatic difference in the types of changes and risks that we take. As we do, here's some of the things to think about. Going up until 2010, so granted, we're a few years past that presently, but this is showing us 50 years worth of data. And at that point, there were a vast difference in the number of total bear markets observed in the different sectors. As we take a look through this list, we see that the market as a whole experienced 6 bear markets. A bear market is when the stock market is 20% below their highs. 20% below. That's a pretty big pullback. As we take a look and see, that has occurred in some areas like materials 12 times, twice as often as happened in the overall market. Consumer discretionary, likewise, 11. Industrials and information technology, 11. But others, like utilities and consumer staples, relatively stable in their volatility. We see that instead, these ones produced much smaller changes. And if we come over here to the right and take a look at the volatility now, not specifically of just their returns, but also what about their sales growth or their earnings or their bottom line? How well are they doing at simply growing or not growing? How's the business doing? Each of these lines represents one of those categories. And the higher the value we see in these, the more volatility, in other words, the greater degree of uncertainty about their earnings. We notice that there's a crazy outlier here in information technology, in which we see the earnings growth varying by as much as 260%. Whereas consumer staples and utilities were nearly 10%. In other words, if you were going to try and say that information technology's earnings have grown at a clip of 30% per year, that's great. But 260 right here tells us you might have seen some that tripled or quadrupled or 5 times their earnings over the course of that same time frame, or that went from a 30% growth to instead nearly zero or even bankruptcy, losses showing up instead of those earnings. Huge swings are possible. Again, by slicing up the market by sector, we start to see that different parts of the investing community react differently because the businesses underlying these indexes are inherently different. It makes sense for there to be additional volatility in the returns of consumer discretionary, your luxury goods, your jewelry stores, your cruise lines, your airlines. It makes sense for these to be a little bit more volatile than are your staples. We'll take a look and see how this continues to break down over the course of the remainder of the session. But the key is that these patterns show up not just on a broad basis, as we saw on the previous, where we saw how volatile the returns have been, but we also start to learn a little about what we've hinted at a few times, the business cycle and business cycle analysis. The business cycle is comprised of 4 parts: the early, the mid, late, and recession phases of the business cycle. During a recession, which it seems like we are always on the cusp of starting, at least over the course of the last decade, that's always been the concern. A recession is when businesses are actually contracting, and that's what this horizontal line represents. If our line up here is above this flat line, it means businesses are growing. Whereas anytime it's below, that means they're actually contracting. You could think of this as businesses closing stores, but we might instead think of it as their overall sales decreasing or their earnings decreasing or other ways to slice this up and understand it. But the key is that they're getting actually smaller. In the early, mid, and late phases, we are always in some amount of growth, but we see that in the heat of the mid cycle, we are way out here, growing and growing aggressively. In fact, so aggressively that in the late stage, we start cutting back on that growth, recognizing we may have gone too far, and the contraction finally trims some of that fat before hopefully we come back into this recovery and moving forward over time. This is important because at different phases of the business cycle, we will see earnings of different sectors react substantially differently. That's what this table is telling us right here. Don't feel like you need to grab a screenshot or memorize this. We will show you where to see this in just one moment, but focus with me on what we are trying to learn. What we are learning from this is that if there's a plus over the course of a long period of history, again, 1962 all the way through 2021, these sectors did dramatically better in the early cycle, or in the recession cycle, or in the late cycle. The double negatives were consistently poor performers on a relative basis. Minus or plus represent, yes, performance, but maybe not as consistently. White boxes say there wasn't a clear pattern. As we observe this, I want to clarify. These say they are outperforming. But to be fair, somebody who is in a rowboat in a ship that sank outperformed the ship that sank. But their situation is not good, right? Better than it could have been, but not necessarily good. Just because we see plus over here in a recession does not mean that consumer staples companies aren't potentially also losing, but they are losing less and doing better than other parts of the market. This is a relative calculation that we are looking at. Outperform versus underperform. Here's another way to visualize this over time. We might think of the business cycle as the blue line in here and how it grows and stretches over time. If we wanted to look more short term, you'd usually call that some sort of a tactical cycle. And then this green line is what you might call the secular business cycle over longer periods. Again, something like 10 to 30 years, business cycle 1 to 10 years, tactical 1 to 12 months. There is no right or wrong, nor is the market obligated to perform as it has in the past. But these are observations that we've seen as a reaction to the human behavior that leads to our growth and contraction in our overall investment world. So that was a lot of data heavy slides here. Peter, were there any questions that came in you want to address or simply clarify based on what you've seen?
Maybe go back to it. I know there were a couple questions that were out there. Stuart was asking Jake I think on your slide there, the components of those Bloomberg sectors. Is that a differentiation maybe that we could answer? If not on the fly, I hate to put you on the spot. I wasn't sure if that was a differentiation in comparison maybe to the kind of GICS system that's out there, or if maybe these were different industry types rather than sectors overall.
Yeah, great question. Bloomberg does compile their own version of these groupings. They call it the Bloomberg Industry Classification System. So it is slightly different in this case, the sectors, but they still relate in the same way. You can guess that most people are going to consider the oil and gas companies pretty unanimously. It may be a little harder to say, is Apple an electronic component company, or are they a semiconductor equipment company, or are they this, or are they that? There we might have to split hairs just a little bit more, but the vast majority are going to be very similar, Stuart. If you wanted to dive in and understand what's in them, you're welcome to Google specifically these items, and you will find the individual securities. Of course, if you have access to a Bloomberg terminal, you can dive much deeper and see the analysis as well.
Perfect. Okay. Thanks for that. I've, folks, just come back from a month off on paternity leave, so I am anxiously awaiting my turn to go ahead and get that Bloomberg Access downloaded. No stranger to it, but it's been some years since I had it on my desk up in a previous role that I had at Fidelity. So I am anxious to get cracking as well. I think I'm gonna do a check on time. We've got a great amount of time here, so I appreciate you doing lots of that heavy lifting. For just a moment, let me go ahead, if I may. There were different questions on maybe where to find some of this information, so I want to at least do quick work on how to get some of this on the website. I can proudly say that I appreciate Jake, either you or whoever it was that was putting this deck together. It is definitely an updated, revamped version of the one that we loosely used to be working off of, which is another reason we always like like to try to show those materials online. But I wanted to come back to, at least just for a moment or two, some of this business cycle analysis that we're talking about, and also this chart here. I think this is a great way to try to visualize this. And if you're out there in the audience right now and you're taking the time to try to learn about these concepts, learn about these thoughts, recognize that being able to, let me just pick a spot here, from a tactical basis, being able to, let's say, call kind of a quote unquote short term bottom and be a buyer, or call kind of what this short term top was and be a seller, and so on and so forth. You get my drift. Being able to tactically, even if you're in front of this, even if you are on Wall Street making big figures, to try to go ahead and do this professionally, it can be a daunting task, which is very, very difficult. Which is also the reason why, if you're thinking about these themes that we're talking about, I think sometimes when I discuss the business cycle with clients, they would say, "Yeah, well, it seems like we've been here for 6 months. It seems like it's going to change, right? Coming up next month." By all means, I'm not here to say when it's not going to change, but some of it is actually waiting for things to begin to change before you want to get too far out in front. It's another reason why, when we looked at those overweight versus underweight ratings from some of those professional firms like Argus or CFRA, they weren't necessarily going completely from one side of the spectrum to the other. They do kind of slower, fine-tune changes based on the facts that they're seeing, based off of their analysis. But this type of thought process as to, okay, where do I want to maybe reallocate a couple percent from, whatever sector it might be, into something else? It's to try to position yourself once again for that lower drawdown if and when things were to begin to take a step back, or at least a pause, while also being able to try to capture that upside potential. So just do recognize that lots of what we're talking about today can be played out not just over days, weeks, months. It could be actually years to play out. And if you're having a harder time trying to, so to speak, catch a bottom or sell at a top or this or that, maybe take a step back and just think to yourself, okay, well, if not this day or this week, how can I try to position my portfolio maybe for the months to come? And then, of course, go back to the well and take a look at kind of the situation at hand or what has changed. Back over at least to, okay, this is a stagnant slide, but much of this information is going to be very, very similar. Where will we be able to go ahead and find some of this on the Fidelity website? Many of you may already know this, but I think it bears repeating here, especially for those that might not be as familiar with the navigation on fidelity.com. If you come here towards the top middle of this green background, news and research, and about 2/3 of the way down, you're going to notice markets and sectors. When you click on markets and sectors, it's going to start off on this markets kind of link or tab. I have then selected sectors. Now, some of this we're already going to go ahead and observe and notice. Off towards the right-hand side, there's something dedicated towards the business cycle. You can go ahead and view the current phase and where we stand. You also have the ability to view some of this sector performance. Down below, kind of a sample of what we had noticed before, communication services, consumer discretionary. This is kind of that snapshot that we had seen previously when we were looking at the market cap, looking at what those market weights were, as well as whether they are overweighting, market weighting, or underweighting, at least as of, well, maybe just a week ago or so at this point in time, which are updated pretty frequently, as you can tell. This is also where, if you wanted to take a look at energy, for instance, you could go ahead and click down below and view kind of what these sample companies might be, maybe different types of news that could be out there, the industries included. Now, obviously, fewer industries here in energy than some of those others that we had observed, but then also some of those sector fundamentals from the standpoint of what is their kind of normalized PE ratio. What are those earnings per share? And I think what you're going to find, going back to some of those sectors that are maybe a little bit more defensive in nature, maybe slower going, slower growing. Maybe they pay a little bit more of a dividend or a dividend yield. Maybe that is what is important to you when you're trying to comprise your portfolio. Lots of this great information is going to be housed here. And I think that you can really just see the major differences when you're, comparing, contrasting things like energy, to information technology, which was there in our sample slide there previously, and then be able to go ahead and take a look okay, well, what's the PE ratio here? I don't know if many of you recall that. It was nearly 5, 6 times what that was there of the previous energy sector that we were looking at. Dividend yield, about 0.8% on average here for the entire sector versus, 4.87 or so for energy. So that's what goes back to being able to have a general awareness or being familiar with different sectors, with some of those benefits or maybe drawbacks, which I guess has a negative characteristic to it or connotation, I should say. It really goes back to what are the characteristics that I should be, as a broad line, casting a pretty wide net for said sector or maybe even said sub industry. And then, of course, you can also find investments which will launch you to our screener, whether it's stocks, ETFs, maybe even some mutual funds that are there. Let me take a step back at least and go here to the viewing current phase. This is great information. If you click here, it's going to take you to much of what we had noticed in those past couple screens or slides that we were taking a look at. And here's that familiar slide that Jake was pointing out for us. You can take a look at this at all. You can also zero in on, going back to Jane's question previously, for international. Well, maybe you're interested in the United States. Maybe you really want to see how India might be stacking up currently, or maybe Japan. Where are their economies currently, or perhaps where have they been in the recent number of quarters? It's completely up to you, your prerogative, which is another reason why I wanted to go ahead and show this business cycle update, which really is kind of from the institutional side of things from Fidelity in that standpoint. Also, there are additional updates, additional links that are down below. Many of you that have been frequent flyers in our sessions know that we are big on taking a look at these quarterly market updates, the different investment research updates that are out there as well that come out on a quarterly basis to try to stay in tune with maybe some of those fine-tuned changes that some of our experts might be seeing here in-house, as well as more of the white paper style approach. Why might business cycle approach be something that you might want to learn more about above and beyond the information that we've talked about here today, and also the business cycle approach. Another, like I said, maybe a white paper that I think is great because it's about 8, 9, 10 pages or so. Even for a notoriously slow reader like myself, they do a fantastic job of breaking this down into different bullet points and getting back to those characteristics, some of which is kind of summarized in that previous slide that we had seen here, which ones maybe historically, once again, historically, have outperformed, maybe underperformed through different cycles, and why that might be something that you want to be mindful of. Let me go ahead also back to our slides for a moment, Jake. I know there were some questions that come through about maybe being able to try to rotate in and out, different approaches to doing that. I can at least give my 2 cents, and then I also welcome your thoughts on this. And the ability to maybe even take it a step further above and beyond those fundamentals that I was just showing from what the current mood is as far as the PE ratios, earnings per share, like Jacob was pointing out, those different growth metrics maybe that they are observing from a sales standpoint or EBITDA. You can also take this to a technical analysis approach as well. And really, one of those technical analysis that, if you've seen some of my charts, I have as a default RSC. I've got an entire tab on Active Trader Pro dedicated towards it that represents the relative strength comparison for some of you that might not be as familiar with that acronym. And essentially what we're doing is what we see in this first bullet point. It's an indicator that was designed to go ahead and compare the price of a security to a base index, or you could really say any other security that you can go ahead and chart or plot. Now, in simply terms, as we're seeing here, we've got a bit of a downward slope or a bit of an upward slope. When the indicator itself is trending up here on this example, the security is outperforming that base index, and then vice versa. So what does that mean? Why do we say that? Well, it goes back to what Jake had introduced earlier. Here, when you notice that they're tracking pretty well, are they one going up, one going down? No, not at all. In this case, with this little snapshot, they're both, for lack of a better term, kind of making higher highs, higher lows. But what the relative strength comparison will do for you is say, you know what, on a relative basis, what you are plotting is either doing better or potentially doing worse than what it is that you are comparing it to. Now, if there are these bigger divergences where that, in this case, base index seems to be rising, and what it is that you've actually typed in and charted is going lower, well, it's a little bit easier to see, okay, this is outperforming and what you're charting is underperforming. But what we're looking to gain, going back to that slide that discussed alpha, was, hey, look, I'm thinking that maybe this sector will do well, but maybe how is this sector doing in comparison to the markets? Or taking it a step further, how is this individual name or equity maybe comparing to its sector? Looking for that outperformance on a relative basis. It really sums up what alpha is. You're looking to go ahead and increase those additional returns while also trying to keep those risk metrics lower. And the reason that you might want to do this comes down to these additional methods that we're discussing. If you're trying to find momentum, or maybe taking it the other side of the coin. Maybe you had seen something that had been underperforming for quite some time that maybe is now beginning to show signs of coming back in favor. Maybe this is something that kind of fell from grace in comparison to its, index or benchmark or sector. And now you're thinking, okay, well, it's beginning to actually show a little bit of that outperformance on a relative basis. Potentially the tides are turning. Maybe investors are beginning to get a bit more confidence or put their money where their mouth is and actually rotate back into a position where they might see some value. All right. As far as that is concerned, let me maybe pause for a moment, Jake, if I may, just for a quick minute or two, show on Active Trader Pro very, very quickly how that indicator can be added. And then I promise, I know there's a little bit more that gets into that technical analysis. I know we didn't want to take it too far, but at least give me 2 minutes to go ahead and show within Active Trader Pro how this can be added to a chart. And then I'll certainly turn it over to you or potentially take some time to answer some questions here in these closing 10 to 15 minutes that we have. All right, so I already had created one. As I had said, if you've seen this in some of the market briefings that we do, I have saved a tab with these indicators. It's going to look very, very similar to that previous slide that we had just come from. But if you wanted to start from scratch and you are not as familiar with how to do this, well, one, we do need to go ahead and plot some type of symbol so we could take a look at, okay, what is the S&P 500 doing? Or better yet, let's say, okay, XLY, how are discretionaries doing? Consumer discretionary sector here based off at least spider sectors, not necessarily those same GIX factors themselves, but you could plot XLY. If you were curious to see, okay, market's been up, discretionaries seem to be up. How is this performing now? How has it performing in the past? First step that you can do is come here towards indicators. You can very simply type in RSC or search for relative or strength or comparison. And once you go ahead and add that, this understudy of a indicator will be added. Now it's telling us, hey, this indicator only works if you can give me something to compare it to. Once again, we're just looking at these price points plotted against each other. So the next step after adding that indicator is to come to compare. Here we have different major indices. You could type in any individual name that you're looking for, or for our intents and purposes, let's just see how XLY is holding up against the S&P 500. So what this is doing, once again, to reiterate, is now we are looking at how has what we're plotting, XLY sector, which is going to be these candlesticks that we have here in the background, how has that compared on a relative basis to the S&P 500? And I think what you're seeing here is that it's tracking pretty well, which would be really gauged by it moving completely sideways. However, let's make this a little bit different. If you're noticing that this is trending lower, what that's telling you is that the discretionary sector that we are plotting here, XLY, in comparison to the S&P 500 as a whole, has actually been relatively underperforming. Now, going back once again, last time I'm going to reiterate it to what Jake said. Is XLY down? No, it's up, nearly 10% or so for this time period that we're looking at for about the past year. However, would you have been better served in hindsight? Once again, always a key in hindsight, investing in XLY or just the S&P 500? Well, clear to see over the past year or so, S&P 500 up nearly 22, 23% or so in comparison to just this single sector up 10. Now, that being said, of course, keep in mind what we had observed with that previous slide. Maybe what you have observed is, you know what? It was underperforming the S&P as a whole for quite some time. If it is able to maybe break this downward sloping trend that it's been in and show signs of outperformance, maybe that's something I want to keep an eye on, or potentially there might be some rotation on a bigger kind of grand scheme of things that you at least want to be mindful of. Doesn't necessarily mean that it's going to catch up and go up with the markets coming down, but maybe some of this relative underperformance that's been showing now for the past year, maybe even longer, might be beginning to turn tides. And that just gets back to a little bit of a technical way that you can try to look for some of those sector rotation strategies. Once again, all that being said, do keep in mind, how does discretionary fall potentially with where we find ourselves in that business cycle? All right, 1 minute past the 10 minutes to go, Mark. Jake, I want to go ahead and pause for a moment. Dealer's choice. Did you want to get back to any more of the technical approaches, maybe as far as analyzing this, or what more would you want to point towards here?
I think you did a great job explaining how this relative strength comparison can help us point towards things. I love using the trend line. And we also have the ability to go ahead and add in there, like we saw in the screenshot from the slides, that you can add a moving average to this. If you click there on the little label, you hit add indicator, you can add a moving average to this. You'll scroll down and click on simple moving average is usually what you might use. By default, it's going to add a 20-period moving average. And we can see this already might start pointing us towards the right ideas. This would be saying, all right, it has been doing worse. If our red line is going down, then XLY has been doing worse recently on average than the S&P 500. But as we start to see the purple line go from below to above, like everything that's happening over the course of the last week and a half or so worth of trading, suddenly there seems to be at least a possibility of a turning of the tides. Maybe consumer discretionary is finally finding its way back into the limelight, moving positive relative to the S&P 500 as an opportunity to potentially shift your portfolio into that if that change in trend continues. Again, all of this is based on history. We don't know the future on the basis of technical analysis, but it gives us some hints at what has been happening and starts helping us with some of these questions, like the one that Christine asked. Christine says, if I understood correctly, the US is in the late cycle. However, information technology is still leading in terms of returns. And you add in that Staples is not. And then is there some sort of misunderstanding? Did you miss the boat here? Well, according to what we're seeing, if we're in the late cycle, we should see consumer discretionary down, energy up, utilities up, consumer staples up, information technology down, right? So why are we or are we not viewing this? There's a few things. This is history. What we're observing presently is the present. But there's a few other nuances to reading this. We should recognize that everything does not move in a line, right? We might hear that one fast food company is laying off workers, and only a few months later, another fast food company also lays off workers. They may have been subject to the same things. However, the difference is that we are looking at this instead in a snapshot, assuming everything moves in lockstep. We are a very squishy world. Everything's tied together, but when something moves, it may take a little bit of time for that wave to hit the rest of the economy. So be aware that they can and do move at different times. But the question you are asking is excellent, Christine. Let's dive a little deeper into it. What we might say is, all right, These are what we would expect during the late cycle. And I had pulled up in front of you for just a moment, and I'll pull it up again, a screenshot. This is the year-to-date performance for the various sectors. This is a list that I compile myself and produce in Excel for some of our sessions. Folks, if you're interested in this type of information and history and what's happening right now, no better opportunity than to join with me tomorrow and actually every Wednesday at noon, where I dive deep into these topics, showing you presentations like this and much, much more. But currently, our year-to-date leader, information technology, and communication services not far behind. And the sole laggard here is real estate. Everything else is positive, but maybe not quite as positive as these two standouts. Well, if we come back to Fidelity.com, for those of you who are wondering how we got to this page, news and research, markets and sectors, one further click to click on the sectors tab. News and research, markets and sectors. And here, our business cycle, is there a period where everything seems to do well except for energy? No, not decisively, but a lot of things are green in the early cycle and energy is consistently bad. So we're at least seeing some information about this. Some information indicating the business cycle has some early cycle tendencies showing up. Or if I flip over and look at a different time frame, this one is instead just the month of June's performance, where we see utilities actually dramatically underperformed, as did materials, and it was information technology joined by communication services and consumer discretionary. Is there anywhere utilities is way down as well as materials? What does that usually imply? Finding materials on our list down, finding utilities down. Well, utilities and materials down does occur in the mid-cycle. So we're seeing some evidence right now of some mid-cycle type behavior. The question is always, where do we expect in the future? And usually a play like this is going to be on the basis of a little longer time frame. These are not 2 or 3 hour or even 2 or 3 day type relative movement trades. Usually those are going to be measured in weeks or maybe even months or years, depending on whether you're looking at that business cycle or the longer secular market over time or very short-term tactical. All of these are possibilities. And for those of you wondering Fidelity's opinion on where we sit, that's where we had to click on View Current Phase. Peter showed this before, and now we can see it. Go ahead and narrow it down to United States, and you can see our estimation is actually that we're here, but the most recent quarter, instead of moving on into recession, instead we actually backed the truck up just a little bit and are a little closer to mid-cycle than recession. Maybe there's still some additional room in this as we continue forward. Now, our minds like to think that we're going to go left to right to right to right to left to right to right to right to left to right, typewriter style, right? But no, this is the real world where sometimes we go backwards. Sometimes we jump straight from early to recession, straight from recession to mid. But if we had to justify and make an overall pattern, this is what we tend to see and how we would look through it. So definitely, I would encourage you to join us for some of that additional material. There were a couple other questions. Kambara was wondering if there's a ticker for tracking the biotechnology for this RSC approach. There is. Let's go ahead and transition into our final idea in the last couple minutes. How do I find trading opportunities in one of these areas? We already saw that we arrived to this news and research, then markets and sectors page. We clicked on sectors. By now scrolling down, we will find the current weightings of all the different sectors. You were right, Peter. Information technology is now 32.5% of the overall market capitalization. It has bloated to an extreme. As we take a look at others, specifically, Kambara was wondering about biotechs. Biotechnologies are part of healthcare. So if we click into this healthcare line, we will find, by scrolling down just a little bit, there is indeed an S&P 500 biotechnology industry and all sorts of details here. You could go ahead and find the specific ticker for this to take a look, but I would encourage you to find some sort of a tradable vehicle in order to do so. And so there's a few ways for us to do this. We can click on this Find Investments link, which is going to require me to log in really quickly. I will do that over here to the side, and then we'll bring it right back. All I've done is click on that little ETFs link.
I've got it also, Jake, if you'd like, but feel free to keep going if you need to log in.
Thank you. I think I've got it. I appreciate
Perfect.
as long as this loads, we're in business. Okay, so now we're in to see about setting up our potential trades based upon what we're looking at this. We could go ahead and take a look at a ETF model portfolio or many other varieties. My preferred method to do this is I usually find I arrive at an idea like this when I already know of one or two stocks that play in this particular pool. If that's the case, and you're on this ETF research screen, you can scroll down and type in the symbol for one company in that, and you will find some of those answers. So there are many different companies out there. Let's just use one of these example symbols for now. But Kanvara, go ahead and type in one of your biotechnology stocks that you like, and you can find something relative. We'll go ahead and plug in this case. Let's just take a look at Apple. How about? If we plug in Apple and hit enter, let's see, for some reason it's not loading. There we go. And we hit view matching ETFs, we can find the current portfolio allocation to different funds along the way, finding those that currently own it. And this is an easy way to find that, okay, here's that XLK, one of those State Street Spider ETFs like XLY that Peter showed us a moment ago, specifically for the technology sector. Maybe there is one specifically to the biotechnology, and there are several, I'll tell you. But as you go ahead and dive in and take a look, then you can use these symbols for that relative strength analysis and addressing those over the course of time. Now, we're officially at time and a little bit beyond. So let me go ahead and take a look as we work through this. If we come up here and you want to learn more, I would encourage you to come to fidelity.com/coaching is the page. Fidelity.com/coaching. And then here we've got a whole listing of variety of topics. If you want to understand how to make your decisions to buy or sell, someone asked, how do you buy low, sell high? All of that discussion about current analysis of charts and the decision making that goes behind them is best found in our daily market briefings. At the start and end of every trading day, meaning in 28 minutes, we'll have another one of these pop up and you'll be able to hop in. We also do one or two during the week in the middle of the day that we'd invite you to as well. If we come down here to trading basics and you want to understand more about this sector analysis information, if I scroll here, the very first one, tomorrow, my class listed here. You want to hear me talk more and more and more about sectors. Every Wednesday, I'm back here at noon to talk all about this. Dennis, you were wondering where that market weighting comes from when we saw it on the previous page. That's just adding up the total market capitalization of the securities. It's not from the Dow Jones Industrial Average, which is actually only 30 stocks. I don't know if you knew that. The DJI is only 30 stocks. It's coming from, in most cases, the S&P 500, but some cases will take from the total market indexes as we take a look. The recommendations shown are not from Fidelity, but rather from analysts that Fidelity provides to you. All right, folks, thank you so much for joining with us throughout the presentation today. I hope you were able to follow along and learn something about sector-based investing. The good, the bad, the ugly, there is opportunity to dramatically change the returns in your own portfolio. I hope that you were not one who happened to be aggressively investing in the drug retail companies at the start of this year. I hope that you had some exposure to semiconductors, but more than ever, after today's session, What I hope is that you recognize that this difference exists and that you need to be mindful of the current allocations of your portfolio and make your decisions in accordance with what you expect for the future. In the end, all we can ask and demand of ourselves is that we make decisions that we can say in hindsight, we did the best that we could. Do the best that you can, folks, and we will be here step by step with you, doing our best to keep you apprised of changing market scenarios as they do constantly evolve. I hope you join us in just a few minutes, 25 minutes from now at the afternoon market briefing or at one of our other classes in the future. But for now, it's been my pleasure. And Peter, welcome back and thank you for being with me today. Take care, everyone.
Absolutely. Take care, everyone. Good to see you.